Trinity Chavez for NYC TV, and joining me today is Pete Mitchell. He is the head of private capital fundraising at PennantPark. This is the final installment in our video series on private credit investing. We'll be discussing fund structures. But before we get to that, Pete, I want to talk more about PennantPark's investor base.
Yeah, thanks, Trinity. I think one of the misconceptions in our business is who our investors are. Our investors in our funds are pension funds, both public and private, insurance companies, endowments, foundations. I've had the pleasure of getting to meet a lot of these firemen, policemen, nurses, teachers around the country. And these are people who've worked their butts off for decades and decades and in hopes of retiring and having a comfortable retirement. And the pension that we invest for them helps provide that for them.
Given that backdrop, what sort of funds do you offer?
Well, we offer several different packages of funds. We offer private funds, which are very popular with our pension investors. They're closed-end funds. They have a defined life and are less liquid. They have less volatility because of that illiquidity. So our pension funds really like those structures. Our BDCs, which are business development companies, are more liquid and they trade daily on the New York Stock Exchange. So those are a little bit more volatile, but they offer daily liquidity, which the individual investor likes.
Now, in addition to private funds and BDCs, does PennantPark offer any other investment types?
We do. We offer CLOs, which sounds scary to the average investor, but they're really very simple. They're called collateralized loan obligations. And basically what we do there is we take our loans and structure them into one company, and we offer different tranches of that company. Insurance companies that want a very safe 7% return, they'll buy the AAA rated notes. Investors that want a little bit more risk will buy the BBB rated notes, and then more opportunistic investors that want, say, a 20% plus return will buy the equity in those structures. It's a big and growing part of our business, and we see that trend continuing to go in the future.
Great. Well, thank you so much for joining me today, Pete.
Sure. Thanks, Trinity.